Welcome, everybody. I'm Susan Murray. I'm one of the partners at Trust Associates. And on behalf of my colleagues at Trust Associates and the team at Edison, thank you for joining us today as we ask our speakers to focus on the challenges facing investment company boards in the months ahead. Now, before I introduce our speakers, just a couple of housekeeping points, if I may. Each of our speakers will talk for around 7 to 8 minutes. Now, that's going to leave plenty of time for questions at the end. And if you'd like to ask a question, and please do, please use the Q&A tab at the bottom of the screen, and we'll try and answer just as many as we can within the time allocated to us. And we're going to aim to finish around 11:45 a.m. So without further ado, let's introduce our speakers today. So firstly, Joe Winkley. Joe is head of investment trusts at Winterflood. He advises over 50 investment companies and is responsible for all listed transactions, including IPOs, issuance, and corporate advisory. And Joe is going to focus on the market perspective. Our second speaker is Elisabeth Scott. Now, Elisabeth will provide a board perspective, something she's particularly well qualified to do as chair of the AIC and an experienced board director. She currently chairs India Capital Growth and JPM Global Emerging Markets, and is a non-exec director at Allianz Technology. Our third speaker today is Simon Westlake. Simon is head of corporate governance at City of London, a specialist investor in closed-end funds. And today, Simon is going to focus on the investor perspective. So without further ado, over to our speakers. Joe.
Good morning, everyone. So we're here to talk about the challenges facing investment trust boards, and I think I've got, as Susan said, I think I've got 7 or 8 minutes. I actually probably could spend a lot of time talking about challenges, and so apologies if the next few slides are going to be a little bit depressing to look at, but I think it is quite important to kind of set out where we are and where the investment trusts are as a sector overall. So if we can just go through to the first slide. What we've looked at here is the performance of the closed-ended, so effectively the investment trust sector against the FTSE All-Share. And I think the chart on the right is probably the one to be looking at, which is the relative performance. So if you look back through the years, sort of 2018, 19 and 20 in particular, you can see that investment trusts effectively outperformed the FTSE All-Share, and we have seen a reverse since then. And looking at 2022, which is obviously the last calendar year, that was actually the worst calendar year since the financial crisis in terms of the performance of investment trusts. And unfortunately, that trend has continued into this year, and we are still, as a sector, underperforming. If you go on to the next page, just picking up on the kind of the why underperformance. I think that it is largely down towards the bias that we see in terms of the investment trust sector. It is biased towards growth stocks, it's biased towards smaller companies. And when you think of the alternative space, it has been very focused on high yield assets. All of these areas have underperformed, and that has led to the underperformance you saw on the previous slide. What it's also led to, as you can see here, is a gradual progressive widening of discounts over the space of the last 12 months or so. If you go back to the very beginning of 22, which actually isn't on the chart on the left, we were at a 2.5% discount across the entire sector. The current number is in the region of sort of 15.5%. And you can see on the chart to the right how that fits within a kind of historic context of the last 10 years. We've been quite fortunate in many ways that we've had a generally sort of narrow discount. You can see here it's fluctuated roughly around about 5% for a lot of that period. There's been the occasional kind of blowouts as we saw in COVID. But what is a little bit concerning about where we are now is you can see that the average discount is getting close to where we were for a very short period of time during COVID, and that is becoming an overall sector discount. So if we move on to the next page, the question is then, okay, we have these widening discounts, we have this underperformance. What is it that the companies, and in many ways boards and directors such as yourselves, what are you doing to try and mitigate that? And we have seen a real pickup in buybacks. And again, if you look at the numbers for 2022, so the thing to focus on here is the little green bit. I don't know how visible it is, but the green part is the share buybacks. Actually, 2022 was a record year for share buybacks. So boards have responded, the market has responded, shares are being bought back. But obviously, as you've seen on the previous charts, it hasn't had an impact in terms of the direction of travel for discounts. They have been widening out progressively over time. Moving on. That obviously leads, when you think of it in a kind of wider market context, that then leads to issues around fundraisings. And looking at these charts here, which is the kind of investment trust fundraising by calendar year, broken down between IPOs and secondary fundraisings, and then kind of just to give a little bit more granularity, breaking it down into calendar quarters, you can see that 2022 was overall a tough year for fundraising. But actually, quite interestingly, it was the first year without an IPO since 1978. And so it really does show how the markets have fallen off. And I think one of the main reasons for that, as I'm sure many people will be aware, is the fact that a lot of the fundraisings that we've seen over certainly the last 10 years have been very much focused on the alternative sector. And particularly alternative income. With the rise in interest rates that we saw, there has been a fall off in terms of the valuations, and a number of discounts have opened up in the alternative space, and that's led to fundraisings being very challenging. I mean, there is a glimmer of light on this, insofar as we have actually seen the first IPO since 21 come out, which was the Ashoka White Oak Emerging Market Fund. So we have seen an IPO come through, but again, if you look at the chart on the right, you can see that that is in the context of really, really muted fundraising conditions. So it is difficult, but when you have a sector at a 15% discount, you would imagine it would be hard for new capital to be raised. So if we move to the next chart, this kind of puts it all into context. So what we've done here is we've basically stripped out the subsector, and apologies if it's small on your screens, the subsectors that constitute what we think of as the kind of the wider investment company sector, and we've looked at the current average discounts for those sectors. The green ones are the kind of more traditional equity funds. The grey ones are the alternative asset classes, and you can see that with very, very small exceptions, you are looking at almost every single subsector trading at a discount, and all of these subsectors have derated from where they would have been a year or so ago. So you can see, I mean, something like infrastructure, that was an area where we've seen enormous amounts of capital raising that is currently trading at a circa 10% discount. So you can see why the previous charts in terms of fundraising, why there are challenges out there in the market. So that's kind of all a bit backward looking in terms of explaining why we are where we are, I suppose, in terms of the market. But let's turn to the next page, which is a little bit more forward looking. And what I've tried to do here is trying to capture some of the themes that I'm seeing in the market at this moment in time, and to maybe think a little bit forward. So clearly, when we have periods of wide discounts, where we have periods where the sector is a little bit out of vogue, what we often see is M&A activity. And what's interesting here, and I flagged it at the beginning, is we're seeing a number of private buyers coming in to buy listed investment trusts. And so I flag here Industrials REIT, and most recently we've seen Civitas Social Housing, where we have seen private buyers coming in offering premiums to share price in order to buy these assets. We're also seeing, and again, this is not unexpected, we are seeing strategic reviews potentially leading to consolidation. And again, I flag a couple here that are live. Edison Property have announced they're undertaking a strategic review. They've indicated their preferred solution would be to try and find a merger with another REIT. Aberdeen Small Companies Income Trust, again, is going through a similar process. And we're also seeing investment trust, investment companies effectively giving up the ghost as well, where they're falling on their swords, they're delisting, they're liquidating. And again, I've flagged 4 here that are currently going through that process. And I think all of this, I think, is a theme that it's not new, in the sense that there has been a lot of talk about consolidation in the sector. And over the last few years, we have seen a number of investment trust mergers come through. But I think it is being accelerated based on where we are now. I think bearing in mind the wide level of discounts, I think it is really now becoming a situation where a number of investment trusts may need to look at themselves and decide whether they really do have a future, particularly if they are subscale. So I think again, I'm looking at sort of themes for later in 2023. I think this theme will continue, and I think it is the right thing for the sector as a whole. So my feeling is that, again, this will be a longer term theme, which is to have larger investment trusts, and for those that are struggling to potentially merge with others. The final point to flag here, which is a slightly different one, but it is an interesting one, is that we've obviously come out of a long period where we've had very low interest rates, and this is something which I think hasn't quite filtered through into the investment trust space as we see it. So obviously the base rate is now 4.5%. Historically, we saw a number of investment trusts, I think with the benefit of hindsight, quite cleverly lock in long-term debentures at very low interest rates. Those days are gone. I think what is interesting is whether there is now potentially an opportunity for some of the debt instruments that we've seen in the past, which are sold effectively to the same buyers that buy investment trusts, so the wealth managers and retail investors, things like Coles and maybe bonds, sort of retail type bonds. Maybe these will come back in now that the levels of interest are potentially going to be higher and more attractive to those investors. So it will be interesting to see how that plays out. But certainly, I think the era of very, very cheap long-term debt is over, and I think from an investment trust perspective, the structure does give that capability to change things. So again, apologies that I couldn't be more positive. I think it is a very tough period of time for investment trusts. I think the one thing that history does tell us, though, is that investment trusts are a very robust structure, and that the sector does come through these times. And so my confidence in the sector hasn't changed, but I do think right now we are a little bit in the eye of the storm. So that's me.
Thanks, Joe. So let's go on to Elisabeth, please.
Well, hello, good morning, everybody. And thanks to Susan and the team at Trust Associates and to Edison for hosting us today. I just wanted to follow on partly from what Joe's been talking about, but also really just to take the board's perspective on the challenges facing investment trusts. And so I've gone with the 3 Ds: duty, discounts, and diversity. And when I'm talking about duty, I'm really talking about consumer duty, which of course is the bit of regulation that's come out recently from the FCA, which doesn't apply to investment trusts because we are not in scope, but it does apply to our suppliers. And of course, as boards, we have a duty to oversee what they're talking about, and in particular, the messages that they're putting out about the investment trusts of which we are board members. The consumer duty in this instance really applies to firms which create, develop, design, issue, operate, or underwrite a product or service, and which may have a material influence on retail consumer outcomes. So what are we really talking about when we as boards are looking at consumer duties, consumer duty? Well, we really have to think about the systems and controls that are in place at our suppliers, in other words, at the managers. And they need to be monitoring consumer outcomes. They should act in good faith. They need to identify and to understand any of the poor outcomes that might occur, i.e. poor performance in particular, and we need to be sure that they've got processes in place to address any issues that might arise. It's also important to think about the consumer or the customer's understanding of what the investment trusts actually are. So there we're thinking about the written materials that are published by the manager on the investment trust's behalf, any audio and visual content that they might be putting out about the investment trust, and any marketing documents that may go out. And I'm glad to say that in some ways this sort of responds to a bugbear that many of us that sit on investment trust boards have, which is so much of the material that has gone out in the past seems to be simply incomprehensible to any retail investor. So I'm really pleased to see that the FCA is requiring investment managers to put out material in good plain English. And the sort of third part of this piece is also about the quality of the customer service that's being provided to investors, and in our case to our shareholders. So what happens about complaints or questions? How do shareholders communicate with the manager? How do they get their information, and is the information available in a way that's accessible to them? So I think we as boards in all of this have a responsibility to ask the manager to report to us about how they're doing on all these issues, about their systems and controls, about the understanding of the customer, and about customer service. And I suspect that for many of us, we'll find that the formal part of asking the manager to report to us on this is through our management engagement committees, most of which meet about once a year. So sorry, but we may need to do that more often. And in particular, if any problems have arisen. So I think it's very incumbent on us as boards to make sure that the managers have got all those things in place and that they are able to report to us on a regular basis. So, sorry, pollen. So how are we going to look at this? One of the principal ways that the FCA requires managers to look at the success or otherwise of their products is through the assessment of value. I'm perhaps lucky enough to sit as the assessment of value champion on an open-ended fund board, so which launched earlier, the fund range launched earlier on this year. So I've had to learn quite a lot about this recently. And of course, it's important to see that the process which a manager goes through to report on assessment of value is adequate and appropriate, and also as a board to ensure that they're not going to red light us, i.e. to say that we do not provide, that our investment trust does not provide good value to the shareholder before we've had a chance to discuss it with them and to act upon it. So I think that it's very important, again, for us as board directors to ensure that we're communicating properly with the manager and that they're not suddenly going to give us a negative rating without us realizing that that was what they were going to do. And I think it's also important for boards perhaps to engage with the board of the manager and to know who the consumer duty champion and the assessment of value champions are on those boards, and to ask them perhaps from time to time to come and to see you as an investment trust board and to report on how and what they are doing to ensure the success of the investment trust. And finally, of course, we write on this part, we do write in our annual financial report about the suitability of the continued appointment of the manager. And that's a very important statement that I think all of us probably take quite a lot of time considering that, both as a board and as a management as management engagement committees, to ensure that the investment trust for which we're responsible are doing what they set out to do. Now, turning to discounts, I think Joe's chart was a rather depressing one, as we've all seen discounts widen out over this year and the last couple of years, and clearly there isn't any single answer. I mean, for many of us in the past, we've bought back a lot of shares and we've seen very little progress in the discount of the share price. And, you know, frankly, at the end of the day, good performance is the key to narrowing discounts over time. But it is also important for us as boards to ensure that we work with both the broker and the manager to ensure that any discount strategies that we have in place are being sensibly and appropriately enforced. And it's also important to engage with our shareholders, not just big institutional shareholders like Simon, but also to try to the fullest extent possible to talk both to wealth managers and to our retail shareholders, many of whom sit on platforms. And I think some of you may have been at the last one of these that I did when I talked about the section 793 that we'd done for India Capital Growth and the success that we'd had at reaching out to our shareholders. So I think engage with your broker, with your manager, and make sure that strategy is working. And then finally, diversity. This is a very evolving discussion. We've had a lot of notifications from the voting agencies about how they will recommend that shareholders vote, and you can find out a lot more about that on the AIC website. But I do think that it is our role as boards to make sure that we explain properly in our annual reports what we're doing about diversity, that we explain our succession plans, and that we are recruiting appropriately, using the right recruiters to make sure that we get the right board members when the time comes to replace the board. And finally, a little pet project of mine, which is holding managers to account for diversity. I think that we as boards have come a long way in terms of the diversity of the boards, but disappointingly, many of the fund managers that are managing the assets, managing the investment trusts, haven't really achieved that same level of diversity that we have, and it would be very nice to see them make progress in that regard in the future. So that's it from me. I look forward to your questions later.
Thank you, Elisabeth. That's great. And last but absolutely not least, Simon, please.
Thank you, Susan, and thank you for inviting me to join your panel. Ronald Reagan famously said the most terrifying words in the English language are, "I'm from the government and I'm here to help." When it comes to investment trusts, I expect some of you hold a similar opinion of City of London. You might see us as part of the problem. But the fact is that we all share the same objective to encourage a thriving sector. Investing in your companies is our business. In fact, it's our only business. We don't do anything else except invest in closed-end funds on behalf of our mainly US-based clients. And we're probably the largest specialist investor in the sector. If we are shareholders in your trust, there's a good chance that we have met, and my message this morning will be familiar. But to start, I thought I'd throw out a couple of surprises, because although our strategy relies on exploiting discount volatility, you may be surprised to learn that our portfolios also include positions in a few trusts that trade at a premium and where we are happy holders. We also participate in IPOs, and there are several instances where we have helped trusts to resist predatory activist approaches by siding with incumbent managers. Earlier this month, there were about 30 London-listed trusts that were trading at a premium. We held 6 of them. One we were actively buying, and none at that time was being actively sold. I imagine some furrowed brows at what I've just said. Why would we hold trusts when there is no discount? The key is that we have to have confidence in their board's appetite for effective discount control. All boards want their trust to achieve a premium to NAV, and with the prospect of growth by issuing new shares, that's an aspiration that we share. But, and if we could move to the next slide, Lucy, please. There are obstacles. Many of these obstacles we can't control. Geopolitical risk is near the top of this list. I think one of the reasons for discounts bleeding out over the last 12 months is undoubtedly the Russian invasion of the Ukraine, for example. And NAV performance is also a factor that is largely beyond your immediate control. Boards provide oversight, but you are not expected to make investment decisions. You do, however, have some control over your costs, and by far the biggest element is the investment management fee. In our opinion, most, certainly not all, but most investment trusts could negotiate more competitive management fees. At the very least, fees should be no higher than equivalent OICs, though from our perspective, institutional rate cards are the more appropriate yardstick. Fees are a key area where trusts can strengthen their competitive advantage. Fees are under pressure right across the industry. If you've not in recent years negotiated lower fees, perhaps above a certain tier, the chances are that the competitive of your trust is not as sharp as it could be. Wealth manager consolidation. Rathbones and Investec are respectively the largest and second largest investors in UK listed investment trusts. Their tie-up announced last month brings together £100 billion in AUM. This is likely to intensify some of the headwinds faced by trusts, particularly those related to liquidity and the viability of smaller funds. We are very willing to invest in smaller funds. Where the discount is wide, it's a good opportunity for us. And other discount-sensitive investors take a similar approach. The result is a concentrated share register, which experience shows is not a good recipe for long-term viability. And all these obstacles lead to wide discounts. If we can move to the next slide, Lucy, please. So what is the way ahead? And this is the familiar part of my message. Our firm belief is that every investment trust should have a discount control mechanism. We would say that, of course, because when discounts widen, our clients see poor performance. But from your perspective, allowing discounts to widen without taking action almost always makes the problem worse and makes it more difficult to remedy in the future. Any SWOT analysis of investment trusts would include gearing as an opportunity. Markets go up over an investment cycle, and ETFs and most OICs don't gear. We are strong advocates, therefore, of moderate structural gearing, and we discourage holding any cash. Closed-end funds have no need to hold cash to meet redemptions, and long-term returns on cash are not attractive. Why handicap yourself? And the third bullet on this slide refers to regular mandate review. I don't want to overplay this point. We're not suggesting that you should chase the latest fad. Mandate changes should be infrequent and need not be dramatic, such as the income tilts, which became popular as rates hovered around zero. Sometimes, however, dramatic change is merited. An asset class that has delivered poor returns over many years, that can't attract new investors, and where the buyback is constantly outrun by sellers. In these cases, finding a strategy that investors want has to be a good idea. Joe's already said a few words about mergers. We're huge fans of mergers, though it's not easy to get them over the line. Bigger, more liquid trusts is the best response to wealth manager consolidation. The latest deal, which was announced last week, involved Aberdeen Japan and Nippon Active Value. We're a bystander in this transaction, but the terms provide an excellent template for the way ahead. A smaller, poor performing trust on a wide discount is merging with a larger, good performing trust on a narrow discount, and the surviving manager is chipping in enough to cover most of the costs. We want to see more mergers. But it's disappointing that some funds, and I think there's at least one on Joe's list of those funds that liquidated, that might have liked to merge, left it too late, casting round at a point when they're too small for a potential partner to justify the prospectus expense. If you're considering this route, don't leave it too late. And finally, a word about performance conditional tenders. If your manager doesn't deliver good long-term performance, then offer your shareholders the option of a 25% capital return at NAV. Taking some cash off the table at a fair price when the manager has done a poor job is not a revolutionary concept. On the contrary, I would describe it as a fair deal. It is fair to the manager, who continues with 3/4 of the fund, and it is fair to long-term shareholders. It will also make your shares more attractive to prospective investors and can therefore be part of the discount control package. So my final slide. I'm suggesting here 5 characteristics to describe the model investment trust. Probably the most important is that it meets an investor need. Good relative NAV performance is certainly an ingredient, but the discount also tells you how much investors want to buy your shares. And clear positioning and strong marketing, we observe, is a common trait of those trusts that trade close to NAV or at a premium. Fully independent boards, completely accepted by most investment trusts, and the exceptions are generally in the alternative sectors where many companies do have at least one manager representative on their boards. We would like to see these trusts conform with normal market practice. It's interesting to note that the discounts of these trusts are among the widest in the sector. Fully independent boards are best equipped to fulfill the 2 key tasks of negotiating competitive costs and implementing robust measures that deliver effective discount control. And that, ladies and gentlemen, is the surest route to a thriving investment trust sector. Thank you very much.
Thank you. Right, so let's have a look at some of the questions that have been coming through. I think we could probably run 1 or 2 of these together. There was a question for you, Joe, just actually on a sort of practical basis. Did your numbers include VCTs?
Sorry, let me just come off mute. No, the numbers wouldn't include VCTs.
They don't. Okay. And then there was a question about, perhaps not surprisingly, about discounts. So if I run 2 of them together, so to what extent is the average widening discount skewed by large funds such as Scottish Mortgage? And secondly, do you think that discounts would now be materially wider if there had been materially fewer buybacks?
Okay, I'll have both difficult questions. So the first question, yes. I mean, you have got a number of very large trusts, and Scottish Mortgage is the classic example, which for a long period of time traded at a premium. It is now out at a kind of, I think, about 7 to 17% discount. So that will affect it. But what we're looking at is the average. And so you can go to any sector and you'll see that there's a wide range of discounts within those sectors. As Simon flagged, there are a number of trusts trading at a premium, and it's perfectly possible and probably the case that in that sector you will find other trusts with wide discounts. So what we're doing is creating a snapshot. But yes, to answer the specific question, clearly the fate of the bigger trusts will affect the discount levels. But I think when you're looking at it, an overall sector average, it's or rather kind of an overall average of investment trusts, it does give you a flavour of where everything is. I think if you want to sort of drill down, having a look at the individual sector ratings gives you more of a flavour in terms of where things are really sold off. But yes, the fate of the big trust will affect the sector. Second question, that is a really tough one, because it's kind of what if all of those buybacks hadn't taken place. So we're talking about roughly 3 billion, and I think the answer is yes, discounts would be wider. Could we say exactly what that number would be? No, because I think there's 2 factors in play. I think the first factor is that, and I think a number of people on this call may be aware of this, that you can't erase a discount through buying back shares, or if you did, you would end up buying back an enormous number of shares. Unlike the open-ended sector, where you have, you can look at open-ended redemptions, we don't have that redemption mechanism, and this kind of tallies with what Simon was saying about having these kind of safety valves, this ability to potentially open end to 25% if there has been material underperformance. What share buybacks are doing are trying to step into that gap and say, we do have an overall net selling situation. And that kind of 2.8 billion will have stopped some of it, but clearly has not stopped all of it. But to say discounts would be 17 rather than 15, I think it's almost impossible to say. And again, you can't really do that with each individual investment trust, because so much depends on what the share register looks like, what the performance is like, what the sentiment towards the overall sector is like, that it's very difficult to kind of come up with a one-size-fits-all. So apologies, I admit I've ducked that question, but I'm not sure there is a real answer there. But I don't know, Simon might want to have a view, but I think it's a hard one to quantify.
Simon, did you want to come in there? Or are you happy to take another question?
Well, I'll just say briefly, I mean, I completely agree with what Joe has said, but I would observe, and I'm not going to name any names here, but there are a few trusts that have said quite categorically, we're not going to buy back any shares, and we don't think it's right to let the market look after the discount. And our observation is that those trusts trade on incredibly wide discounts. So if that's and obviously it's something that that trusts can do if they're controlling shareholders who've got other agendas. But I think if you're not in that position, then it's a dangerous line to take.
Okay, thank you. There was a question about subscale sized investment trusts and what size is subscale. It might be interesting actually if everyone just had a brief sort of response to that. Elisabeth, can we start with you? What do you reckon is subscale?
Well, it depends who you talk to, doesn't it, really? I mean, some people will say that $500 million is the smallest size that a wealth management company will now trust. But as you probably all know, I'm on the board of an investment trust or I chair the board of an investment trust that's £130 million market cap. But it's a very specialist trust. It does India mid and small cap stocks. And I think that's it would be very nice to grow it, but I think it's not an unreasonable size for a very specialist mandate, and we've got some very good and very loyal shareholders who like what we do. So I think it's tough to put your nail on it, put your finger on it, unless for your broadest spread of shareholders, you're going to have to be bigger than that, though. So 250 million maybe. I don't know, Simon will have a view.
Yes, Simon, do you want to come in there?
Yeah, I mean, as I said, we will invest in very small trusts, where there's a wide discount. I think obviously boards, have different agendas. I mean, we invest in small trusts because we think, typically they've only got one way to go, and I think therefore, if you are below 100 million, unless you have a very specialist strategy and you regularly offer some sort of tender or redemption mechanism to your shareholders, to keep the discount narrow, then you're going to struggle to grow, and therefore you should consider finding a merger partner, or if you've got a very specialist strategy that's trading close to NAV, then possibly there will be some growth opportunities, but definitely below 50 million, you're in a hole that you're not going to get out of. A Shocker launched their new fund the other day at 30 million, clearly hoping that that's going to be a platform for further growth, and good luck to them. But I think if you're coming the other way, from sort of higher down to the lower level, it's very difficult to dig yourself out of the hole.
Joe, did you want to add anything to that?
Yeah, I think the only thing I would say, I mean, I agree with everything that's been said so far. The only thing I would say, though, is that to me, one of the key questions around size comes down to who the investor base is. And so to pick up on Elisabeth's point, if your target market is the large wealth managers and institution kind of multi-asset type investors, you need to be, I mean, we can talk about 500. You certainly need to be a minimum of 250. I think 500 is a number for the large wealth managers, and that number may keep going up. But there are a lot of investment trusts out there that are below that size, and they are, we're seeing more and more trusts that have got a lot of retail ownership, and by that I mean kind of platform ownership. So Harvey Lansdown, AJ Bell, and there are trusts out there that are sub 100 million in size, where they've got 90% retail ownership, and that can provide the liquidity that those investors need. And yes, you're not going to attract the big wealth managers. You may not, to Simon's point, you may not even grow. But then it becomes a question of, well, if you're serving a need for those particular investors, if they are happy with what you're doing, if you're performing, then you don't really need to grow. And I think that that's where I draw the distinction is clearly the number or the size of the market cap you need to appeal to larger investors is gradually going up as they get bigger and bigger. But I would have a look at your register and say, well, do we need them? What does our register look like? And where are we seeing buying interest coming from? And if, in fact, buying interest is coming from the smaller wealth managers and retail investors, you may be able to survive and indeed thrive at a lower level.
Thanks, Joe. An interesting question on what does the panel, so this might be one for everyone, believe can be done to market investment trusts more widely and more effectively? And perhaps importantly, will boards pay what is required? Who wants to go for that one? Elisabeth, do you want to start off?
Sure. The answer is a lot can be done to market investment trusts more widely and more effectively. And a lot of investment trusts have been doing that. And yes, boards will pay. I mean, sometimes if you can come up with a really effective marketing strategy that really gets the message out, it's, you know, compared to having to buy back a lot of stock and the impact that that might have on your underlying costs, that can actually prove to be a cost-effective way of doing things if it can, if you can do it effectively. And so I think there are a number of examples out there of people that do very good jobs as far as marketing, particularly as far as reaching out to retail shareholders is concerned, rather than to the more institutional or private wealth manager arena. But yes, boards will pay if it can be shown to be effective.
Okay, just in the interest of trying to sort of get through as many questions as we can, and on the basis, Simon, Joe, did you want to add anything quickly, or can we just move on?
Fine. Nothing from me on that, no.
Okay, there was a question, one of the audience was a little bit surprised that no one has mentioned climate change or ESG as a challenge. Does anyone want to pick up on that one?
Well, I mean, I'll just say a quick word. I mean, I was given 10 minutes, so I decided to cut out ESG because the you know, our overwhelming priority is performance and exploiting discount volatility. But ESG is definitely an issue, and we don't actually have any ESG strategies, but we do consider that boards should be doing as much as possible to make the ESG characteristics and managers the ESG characteristics of their portfolios as transparent as possible, and to explain, you know, how they're taking it into account. And I would say overall, most trusts are pretty good at that.
That's great, thank you. Now, a question, Elisabeth, you mentioned diversity. There was a question asking what your thoughts might be on boards having to specifically increase their size to fully meet diversity targets if there's no imminent recruitment planned.
Well, it's sort of up to you as a board, I would say. I think what's absolutely vital is to explain in your annual report what your succession plan is, and that can help to alleviate any issues that might arise from the fact that you may not have yet met your targets, particularly around ethnic diversity, where I think it's one board member, which is fine for a board of 12, but if you happen to be a board of 4 and you're not thinking of, you know, you're not in the process of recruiting now, that can be more challenging. But I do think also that the boards need to work really hard with their headhunters to ensure, or their recruiters to ensure that they are, you know, exploring as wide a field as possible to ensure that you get the best candidates possible.
Indeed. Now, I'm just conscious of time here, but before we sign off, I'd like to ask each of our speakers just to leave us perhaps with their key message from today's webinar. So let's go in order of speakers. So let's start off, please, with Joe.
Key message. I'll try and kind of leave on an upbeat note. So I'll just reiterate something that I said at the very end, which is the investment trust sector has been around for a very, very long time. It has weathered a number of storms. I think we are in as a tougher situation as we've been for a period of time. But I think that in terms of what the structure delivers, in terms of what outperformance you get through a closed-ended fund versus an open-ended, in terms of the ability to use gearing, in terms of the ability to use interesting investment approaches and interesting asset classes, I think the investment trusts still have got a very strong future ahead of them.
Thanks, Joe. And Elisabeth, a message from you?
Gosh, I'm not sure I need to add to anything that Joe has just said, but I do think that having board, as a board, an inquiring mind as a board whole is important, and being able to adapt to the new and changing environment that is around us is important.
Thank you. And Simon, a quick message from you?
Yes, well, the pickup in buybacks last year, I just want to be quite clear, is absolutely the right response to wider discounts. Please keep it up. And also consider whether a performance conditional tender mechanism could provide your shareholders with a fairer deal.
Thank you. Well, many thanks, of course, to our excellent speakers, and of course to you, the audience, for joining us today. We hope you've enjoyed it and found it useful. Thank you again, and have a great day.